Welcome to Sovereign Finance, the show that connects the dots between personal finance, global finance trends, and deep human history. Tune in every week to demystify the money puzzle and protect your interests in a turbulent world. Hi, this is Rob Drummond. Welcome to Sovereign Finance. I'm here, as always, with Derek Dearden. How's it going, Derek?
It's going very well, Rob, and how about you?
Yeah, not too bad, thanks. We're going to have a bit of a change of gear on today's episode and talk about a topic which I think is definitely of direct interest to me and maybe of direct interest to anyone listening who is an entrepreneur or a small business owner, is maybe starting out or has recently started out in the last 5 years, and that's personal finance as it relates to you and your small business. So where do we need to start with this one?
Okay. Well, I think what we need to do is have a look at what the three basic forms of financial statement are and what they mean to you if you're running any kind of business, and also how it relates to you as an individual personally. And also, it's essential to have an understanding of this when you're considering how to deploy your savings with a view to building up a nest egg over the course of a lifetime to provide you with an income in your later years and give you freedom from the necessity of spending any time working. So, accounting is generally a topic that a lot of people don't feel intrinsically enthusiastic about. I know I don't. I know I didn't. And I know I've suffered from that, both personally and as a business owner. The other thing is people feel that it's arcane and difficult and complicated. But in fact, what I would say is, first of all, it's crucial to understand these things. And secondly, it's not rocket science. There's nothing complex about it. And really, it's one of those things that our education service, yet again, serves us extremely poorly in. It's something that should be part of everybody's background understanding of how the world operates. And I think it's deliberately been kept obscure because the more obscure it is to more people, the easier it is for the bad actors in our society to exploit them in various ways.
It's much safer to stay on payroll and
Yes.
not take any risks.
Okay. So the three sorts of financial statement are firstly the cash flow report, secondly the profit and loss summary, and thirdly the balance sheet. And I'll start out by drawing an important distinction. There's a distinction bit called stock and flow, and this is kind of once again fairly obvious once you face it head on, but there's a lot of obscurity around it. A stock is how much of something you have, and a flow is the rate at which that stock is increasing or decreasing. If you look at what that means literally, suppose you might have a supermarket, they might have a stock of cans of baked beans. The stock is the number of cans they've got, and the flow is either the number that they're purchasing and increasing their stock level by over a period of time, or the number that they're selling, which is decreasing the level of stock over a period of time. You can think of the analogy of water in the cistern. You've got a pipe coming out of the system, distributing the water to wherever it's going, and you've got a pipe coming in, probably and they'll both be regulated by valves in some way or another. And the object, the exercise is that you have enough of a buffer there that on the one hand, you're not going to run out. if you're temporarily drawing more than is going in. And on the other hand, you're not wasting too much by having too large a stock. So, for financial statements, what we're talking about is we're talking about the stock of money. So, uh, if we think about the simplest possible situation, let's suppose, as was the case for a large proportion of the population not so long ago, you lived in an entirely cash economy. Uh, let's take the case of somebody who's working for a weekly wage. At the end of uh, at the end of each week, they get their wage packet. The stock of money they have has gone up to probably as much as it's going to be for most people, as high a level as it's going to get to. And then as the days go by throughout the week, they spend that and the stock of money goes down. So the cash flow statement is a statement of the money coming in, the money going out, and what you're left with is a balance. So that's the cash flow statement. The profit and loss is, if you like, is a statement about the profit and loss is also a statement of flow. And it obviously is closely tied in with that cash flow, but there are a couple of subtle differences. The differences are that most of the money going out for most of the people in that situation would be an expense. Once it's spent, it's gone. They buy food, they eat the food, and there's nothing to show for the money. They pay rent, and there's nothing to be seen for that as far as they're concerned. On the other hand, some of the things they buy might be an asset. It might be, some furniture or a washing machine, television set, and then so they now have an asset. It might be, it might have gone out of their actual cash holding and into some form of savings or investment account, and then they're left. Although they haven't got the money, they're left with an asset of a different type. So that brings us round to the third kind of statement, which is the balance sheet. And the balance sheet, you add up all your assets and you subtract from them the liabilities, which is another thing which is a distinction from the profit and loss account. For example, let's suppose that by Wednesday or Thursday they've spent all their cash. They still need to buy some groceries. A lot of people in years gone by ran a situation where the local shop would allow them to take goods as they put it on the book, as we might say today, on credit. And they'd expect that to be discharged when the next paycheck comes in. It was an informal arrangement. If they didn't pay up on the Friday when they got their wages, they probably wouldn't receive any more goods on credit. If they did it a number of times, they probably wouldn't get it served at all. So it was kind of self-regulating. And in those days, middle-class people used to run an account at the local department store. They'd buy their clothes and their furniture, domestic appliances there. The strict arrangement is that those would be settled at the end of each month. And once again, there would probably be an informal arrangement whereby it was a substantial purchase and the customer was in good standing with the store. They'd let that spread over 2 or 3 months or maybe more. So there would also on that balance sheet be liabilities. So you can see how that would stack up if you add up all of the assets you have including any cash in hand and all the liabilities, and subtract those from the assets, you're left with your net worth. And if that's negative, then technically you're bankrupt. And it's pretty easy to see how that would operate with a small business. It depends on the kind of business you're running. Um, if you're running essentially a resale operation of any kind, your assets are going to be whatever you need to operate the business, plus whatever you've got in stock ready to sell at any given time. And if there's a manufacturing element, you've got the stock that you've bought to use as components in constructing whatever it is you're manufacturing, and the finished goods that you haven't yet sold but you're going to. And then you would add into that the liabilities that you have. For instance, you might have bought some of your stocks on a credit account. You're due once again to pay those at the end of the month, or might stretch it for a couple. You'd have to take that off as part of your liabilities. You might have, on the other hand, sold some goods to customers on credit, so the accounts receivable will be part of your assets. So you can see it's a slightly more complex situation than the straightforward calculation of money coming in, money going out, and the difference is the cash balance. Any questions on that? Any comments on that?
There's no. So I think just as an observation, the balance sheet is more like a snapshot at any given time because it doesn't account for the direction of travel.
Yeah.
My balance sheet as a service provider is actually very simple. I don't have tremendous assets, but that's because I'm not reselling goods and things like that.
Right.
The other thing that occurred to me was that anecdote you were saying about people having a line of credit with the store and then settling it at the end of the month. Like, to a degree, that is actually how I currently operate my business.
Yeah.
If a client's in good standing, like I will let them spread a large bill over like 3 months, 6 months. If they stop paying that monthly installment, then it'll grinds to a halt.
Yeah.
So I think a lot. It sounds archaic, but I think quite a lot of people still operate on that basis, especially B2B.
Yeah. Okay. So
I just wanted to drill down a bit on the difference between the cash flow statements, and the profit and loss.
right.
The profit and loss just being a bit more detailed as to where stuff has gone, or
Well, I think the main thing is that let's look at the money going out. There's a distinction between money going out, which is an expense. You might have to pay for your tax and insurance on your car. You have to fill the car up with petrol. You have to get it repaired. All of those things are expenses. Once they're spent, they're gone. So that is a negative impact on the cash flow, obviously, and it's also a negative income influence on the flow of your profit and loss account, and it's also a reduction in the balance on your balance sheet, because you have the cash to begin with. You then spent it on filling the tank up with petrol in your car, driving around in it, using the petrol up. So you now haven't got the cash anymore. You haven't got anything else anymore, and your net worth has gone down. On the other hand, you might make a payment, and the payment is to acquire an asset. You might buy some stock. You might buy a new computer, which is going to last you several years. And so, although the cash level has gone down, it hasn't reduced your profit by that amount, because you've acquired an asset. Or you might pay off an outstanding account with one of your suppliers. So once again, your cash has gone down, but your liabilities have been reduced, so it hasn't reduced uh, the balance sheet by the amount of that cash. Similarly, uh, you might have um, obtained some more stock from a supplier, so you now own that stock. So your assets have gone up, but it hasn't actually impacted the cash flow because you haven't paid for it yet. You're going to have to pay for that at the end of the month. But from a balance sheet point of view, uh, that purchase hasn't really affected the uh, equity, as we call it, the difference between your assets and your liabilities, because uh, you now have the assets in the form of stock, but you now have a liability in terms of the money that you owe to the supplier. And does that elucidate that?
It does, yeah, yeah. Thanks.
Yeah. Um, okay, and so I think that's probably a good place to leave it for today, because both it's very clear what that means to you as an individual, and it's easy to relate to how that relates to perhaps a slightly more complex situation if you're running any kind of enterprise. And obviously, depending on the type of enterprise it is, the details will vary.
So it's worth pointing out that this applies to you as an individual if you're trading as a sole trader, but it could also apply to your company if you're trading as a company. That's just,
Yeah.
yeah.
And I'll just leave the thought to maybe take up in more detail on the next on the next discussion, which is that when you're thinking in the context of investing, um, if you it's only possible to have to build up an asset over a lifetime that is going to support you in terms of funding a pension when the time comes that you need that. If not only is the money going into it, which you're paying directly, but also it is itself earning money over the years. And the way it does that is, of course, that uh, the the capital sum being built up in your pension fund from your payments is being invested in usually much larger enterprises, which are themselves turning a profit, and they're funneling that profit into there so that it's accumulating over the years. So, uh, although a lot of us take no responsibility at all for the way that our pension funds are being invested, it would probably serve us well to have enough of a grasp of it and enough flexibility in the plans that we make in that area to decide where those funds are being defrayed, and to understand that the kind of financial statements that we've just been discussing, the cash flow, the profit and loss of the balance sheet, decide how we're going to evaluate the companies that our pension funds are going to invest in, and see how to select performers. And this is, again, something that a lot of people regard as completely arcane, completely beyond the capability of a normal person to grasp. And that's why we just take it to the path of least resistance and leave that to the fund managers of whatever scheme we've signed up to. But we'll look at the way that works, as I say, in a bit more detail. But I think if you start with the grasp of what it means to you as an individual, what it means to you if you're any kind of entrepreneur, and therefore just see that those same principles writ large are what you need to evaluate when you're deciding whether you're going to invest in Procter and Gamble or Apple or whoever it might be with your funds, or what kinds of guidelines you're going to um, see being exhibited by whoever's actually doing the active management of the fund on your behalf.
Yeah, and we've done a separate episode, haven't we, about why pensions often aren't worth as much as you think they might be.
We have got that one, yeah.
But I think it's probably a fair comment that pensions are probably still like the bread and butter for wealth management and accumulation. Like it's still probably like the main thing to look at.
Yeah.
So great. Well, maybe we'll pick on that next time.
Yeah, I think so. Thank you.
Okay, thanks, Derek.
Fine.
Thanks for listening to this episode of Sovereign Finance. For more episodes, transcripts, in-depth articles, and community, please take a minute now to subscribe free at sovereignfinance.substack.com. See you next time.